Right. In this video, we're going to take a look at monetary policy and understand how it's conducted given a economic environment and whether people are relatively unemployed, as in there's a relatively high unemployment rate, or whether we're in a expansionary period where GDP is growing rather consistently. So previously, we've taken a look at fiscal policy, and with the goal of fiscal policy to be to kind of smooth out the fluctuations that we see in the short run via the business cycle. Um, this week, what we're going to talk about is monetary policy, and unlike fiscal policy, which is conducted by the federal government, monetary policy is going to be conducted by the Fed. The same counter-cyclical approach is going to be taken that we saw with fiscal policy as for monetary policy. But again, the Fed's going to be conducting monetary policy. So during a contractionary period, what we'll see is the Fed is going to make credit more available. The Fed's going to make credit more available by lowering the federal funds rate. And the federal funds rate is just the interest rate that kind of dictates all other interest rates that we see in the market, in the credit market. So lending rates for households via loans or mortgages for household purchases or for house purchases, and interest rates on car loans, that's all going to be influenced by the federal funds rate. Additionally, the federal funds rate is going to dictate the price that firms pay to take out a loan to invest in new projects. So the investment into capital is going to be dependent upon interest rates. That's going to be dictated by monetary policy. So typically what we see, again, is that the Fed is going to lower the federal funds rate, make interest rates relatively lower during contraction periods, with the idea that they're going to try to stimulate lending, okay? Lower the cost of borrowing to be able to invest in something. The opposite is going to happen when the economy is in an expansion state. In those times, we're going to see the federal funds rate rise, and we're going to see interest rates rise, making lending relatively more expensive. So graphically, if we take a look, we can see that when we plot the unemployment rate with the federal funds rate, well, we can see that when the unemployment rate in blue, the federal funds rate in red, we see that starting in the 80s, we can take it from 1990, when the unemployment rate starts to rise, typically in coordinates with the recession periods that we see in the gray bar here. Well, when unemployment starts to rise, we see federal funds rates start to drop. Okay, and so we're seeing this counter-cyclical movement, which is essentially, visually, what does it look like? It looks like when the blue line goes up, the red line goes down, which is pretty much what we see during recessionary times. During expansionary times, the opposite is going to be true. The blue line is going to go down, which is what we see here, while the red line starts to increase. Okay, so this is kind of a visual representation of this counter-cyclical policies that we've been talking about, specifically manifesting itself in the federal funds rate when compared to the unemployment rate. Okay, currently we see that coming out of the Great Recession in the early 2000s, the federal funds rate was held low for a relatively long period of time. Unemployment rate was still, relatively high during that period, peaking at about 10% while dropping down to about 5% before we started seeing increases in the federal funds rate. But you see that the interest rates were relatively low for a long time. They started to increase about 3 or 4 years ago, up until when we went into the pandemic and the economy started shutting down. Then we saw, when that started to occur, we saw interest rates drop pretty drastically in the beginning of 2020. In the upcoming videos, we'll talk about the specifics about the Federal Reserve Bank and how they manipulate the federal funds rate in the reserves market.